Welcome. I hope your day started with money. Today, I'm here at my second property, passive income. And just like rain, money also flows here. So, for today's video, I'm going to talk about one thing that can be very hard for investors, and that's knowing when to sell. If you sell too early, you can miss out on huge gains. If you sell too late, you can lose all gains previously made. So, in this video, I'd like to share an example about how I'd go assessing a stock in my portfolio. Previously, I made two videos about ISS over at my vlogging and rap music channel, where I presented the stock as a good value play at share prices of 125 and 160. Since then, the share price has ballooned to almost 190 krona. They're returning a lot of money to shareholders, and it's time to reassess the valuation. To recap what ISS does, they provide facility management in the cleaning, technical, security, and the other service spaces such as food. Most of their customers are regular offices, healthcare spaces, manufacturing plants, and airports. Pretty boring business, I know, but at the Hanken Cash Club, we don't see boring, we only see green. Here is the share price chart since their IPO in 2014. It looks like they haven't gone anywhere. In fact, it looks like they're still recovering back to their peak. If we add the operating margins on top of this chart, we see a clear correlation. COVID was terrible for them, but they become weaker way before then. From their all-time high to their 2020 low, they had a drawdown of 72%. If they manage to get back to 5.6 or 5.8% operating margin, this rally can go on for a while still, and I wouldn't be surprised to see this stock as a great investment if they also manage to grow a little bit. And if we want to simulate a bull case scenario, we could take the 2024 revenue of 83.7 billion, grow that by 5% annually, let's say 3 years, times 5.7% operating margin, times 65% cash flow conversion, times 14 times cash flow multiple, times 1,000 to get the same figure in millions, divide by 168.2 million shares, but we shrink that by 7% annually due to their buybacks they're performing. And that gets us a share price of 366 krona, which divide that by the current share price to get almost 100% upside. So there's still a lot to get. But if we look at the income statement instead of the stock chart, we can see some improvement since 2015. The revenue has increased by 5% with ups and downs. Meanwhile, shares outstanding have reduced by 8.5%. So the company seems to have really turned around this time, and they are in a better position now than earlier, and at the same time trading at a lower valuation. And for the market analysis research, I brought in my Swedish-speaking quant, Bjorn Viking Ragnar. Thank you.
Thank you for having me. The case for their continued growth also looks strong to me. The global IFS market is expected to grow at a faster rate than GDP and is still highly fragmented. ISS is in a good position to acquire smaller firms at low valuations and unlock synergies through firing the excess managers. The market growth makes sense too. Companies want to outsource as much as possible to keep an asset-light business. And while the number of employees in offices have shrunk since 2019, IFS spending per employee has risen since then, more than offsetting the decrease of employees. This makes sense too. Companies want to keep their top talent, and they want to attract people to stay longer at the offices and be more productive while being there. ISS knows this. And that's why they're using data and their large scale to optimize how they work in order to make the experience as good as possible for their customers. The smaller companies that still compete in this fragmented market also have a worse position than ISS when it comes to data and optimization, so it also plays into consolidation.
Thank you very much, Bjorn. So, for the valuation, here is the same model from a previous video. And that's still playing out. It shows that you could get a double in under 4 years. But if the management can't execute and the margins doesn't improve like projected, we can have a look at the second table here. Assuming 4% organic terminal growth rate and a 2.4 billion free cash flow for 2025, we're at 13 times now, and you could expect a long-term yield of about 11.7%, which is pretty great. If they improve their margins and multiple, you could get a higher return now, but to expect the yield forward would obviously drop. The same goes for contraction. And if we look at this graph again, I'd be a bit worried about margins compressing again due to something. Their net debt to EBITDA, which is 2 times right now, would also balloon if the denominator shrinks and if they have to take out more debt, which would lead them to stopping their buybacks, which are huge right now, and it would also lead to lower multiples and a significant share price reduction. And ISS would have a whole turnaround story again, kind of like what we saw beginning before 2020, where their net debt to EBITDA rose to over 7 times. And yeah, since then we have this turnaround story that we've been playing here at the Hunk and Cash Club. So what to do? Well, please do your own research and do what is best for you. But personally, ISS is approaching 15% of my portfolio, and I've been looking to trim to take some profits at around 14 to 15 times free cash flow. But in either way, I would want to wait until the earnings that happens on 12th of August and see if they increase guidance for cash flow, what happens if they say anything about the Deutsche Telekom payments, and I would factor that into my forward free cash flow. If I do trim and the stock price continues to rise after that, I still have skin in the game and be able to get profits. But if the bear case strikes, I'd be ready to deploy more capital back into the stock at more attractive rates. That's pretty much it. For shareholders' returns, stay cashing.